Welcome to The Business. I'm Alicia Barry. Coming up on the program, hotspot handouts. The federal government agrees to wages support for stood-down Victorian workers.
The amount that the federal government has announced today is a third less than the minimum wage, and it's half the standard disaster relief payment.
And how wealth management firm IOOF is reinventing itself after the Banking Royal Commission.
There are a lot of lessons to be learnt through the Royal Commission.
Victorians who've lost work because of the lockdown will be able to apply for a relief payment as part of a financial support package from the federal government. The cash will be made available to other states if they've been declared a Commonwealth hotspot and are in lockdown for more than a week. But there are strings attached and a lot of exceptions, as NEWSThe reports.
Behind Melbourne's lockdown streets, there's pain.
Very, very anxious. It's like all that I can think about.
It's too little, too late.
I basically lose all of my income.
Jess Taylor doesn't know how she's going to pay for food and rent. The restaurant worker normally works up to 40 hours a week. Now it's zero.
I feel really upset.
Last week, the Victorian government provided $450 million to businesses, but nothing specifically for workers. Now, the federal government's come to the party with a system similar to that for floods and fires.
The temporary COVID disaster payment.
It includes grants of between $325 and $500 a week.
The amount that the federal government has announced today is a third less than the minimum wage, and it's half the standard disaster relief payment.
We've seen a terrible economic and health situation rapidly become politicised, and that's in nobody's interests.
Business, contractors and sole traders like gallery owner Lou Clerks have all seen their incomes crushed.
I almost don't want to look at what my financial situation is at the moment. The wait times for these grants means that I rely on my personal savings, and it's been like that since the beginning.
Before the lockdown, about 28,000 shifts a day were being recorded in Victoria by rostering software firm Deputy. That fell by 2/3 when this latest lockdown was announced. Work has fallen the most in bars, restaurants, hotels and motels.
Quick action is the best action, and it's important that people do have money quickly. There's already great distress out there. The quicker we can get money to people, the better.
The federal government support has strings attached. For example, people with savings of more than $10,000 won't get the payment no matter how long the lockdown drags on. That includes Jess, who's been saving for a house deposit.
If it gets extended, it's just completely unrealistic and unreliable, and I can't, support myself on that in the long term at all.
The support package will be used in future lockdowns, extending more than a week.
The government has made it very difficult for people to get the payment, and it's not enough for them.
A safety net for uncertain times.
The ink has just dried on wealth manager IOOF's $1.4 billion acquisition of MLC from NAB. The new company has nearly $500 billion in funds under management, administration and advice, now surpassing AMP as Australia's largest provider of financial advice. Both IOOF and MLC suffered serious reputational damage from the misconduct revealed by the 2018 Banking Royal Commission. So, how is the firm rebuilding trust with customers and advisors? I asked CEO Renato Mota. Renato Mota, welcome to The Business.
Thanks, Alicia. Good to be here.
What does the acquisition of MLC do for IOOF?
Well, the acquisition of MLC and completing the acquisition really sets a clear path for us as a leading organisation in wealth management, and in a period of time in our industry, which is really going through a lot of transformation. So for us, the completion of the transaction really does set our clear path of delivering value to clients as well as our shareholders.
And when you say clear path to delivering value for shareholders and clients, what does that mean?
With the acquisition of MLC, we in fact double in size as an organisation, and the reason that scale is important is that we know through our experience that through scale, through having more funds under management or more funds under administration in superannuation, we can actually lower the cost to serve to our clients, i.e. we can deliver a better price point for our clients, delivering better outcomes. And equally, those synergies that come from removing duplicate functions also allows us to deliver a return to our shareholders.
And when you say synergies, is that code for jobs to go?
There are some duplicate functions across both organisations. As you can imagine, when you've got two large organisations, there are like teams across both sides, and we owe it to our clients as well as our shareholders to create a simplified operating structure as well as a simpler business. That does mean there will be some jobs to go, but ultimately the benefits of those synergies will go both to members, clients, as well as the shareholder.
How many jobs are you talking about, and has that been flagged?
We haven't flagged a specific number in terms of how many jobs are impacted. We have said that we expect $150 million in synergies over the next 3 years.
The banks were fairly quick to hive off their wealth management arms after the fallout from the Banking Royal Commission. Why were you so quick to pick them up?
I think if you look at the evolution of this industry over the last 20 or 30 years, there was no doubt in the early 2000s that there was a real commitment from the banks to what I would call the bank assurance model. And that is for the banks to have end-to-end client ownership through including of wealth. So we saw all the banks really plough into wealth management and buy a lot of the high quality assets, including MLC and including the businesses from ANZ. I think we're now seeing a cyclical move away from wealth from the banks. And so we're going to an environment and to an industry structure that looks akin to what it did in the 90s, when you have pure play, focused wealth management organisations representing the superannuation and the overarching wealth management needs of society in our communities. So in some ways, there is an element of going back to the past, industry structure-wise. From our perspective, and the reason IWF was very attracted to this, was the fact that our focused management around wealth management, we don't do anything else. The talent of our people, we think there's a tremendous opportunity to really create a trusted organisation that's committed to delivering better outcomes to communities.
The Banking Royal Commission revealed that IWF used its super members' funds to compensate for an accounting error rather than dip into its corporate resources. And the fallout from the Banking Royal Commission essentially resulted in the ousting of Chris Kelleher, the previous CEO. How is IWF different now?
Certainly, I think from an IWF perspective, there are a lot of lessons to be learnt through the Royal Commission. One of my first decisions that I made as an executive, as CEO, was to uplift the governance standards within the group. And I think we've worked very hard with all our stakeholders, including regulators, over the past 2 or 3 years to restore IWF and create a really transparent environment where it's evident to all what we stand for and how we deliver value.
Well, you've been there since 2003, and 3 of the 5 board members present during the hearings of the Banking Royal Commission are still there. How confident are you that change culturally is happening?
I think that the cultural transformation of the group is evident for all over the last 3 or 4 years, and certainly since the Royal Commission. As I said, I think we've spent a lot of time on our governance uplift, on our culture, and certainly I think as an executive team, there has been significant turnover in the executive team, and I'm very happy with the talent, the calibre, and the value set of the executives leading this group going forward.
And a final one, what's the outlook for the business now?
I think we've got a really positive and mindset in terms of our outlook. We've got an opportunity to create Australia's leading wealth management organisation with a very clear strategy that's oriented around creating more financial wellbeing in the community. We've got an incredibly talented group of people, and we now have the scale through which we can deliver better results to our clients and to our shareholders. So it's an exciting time ahead.
Renato Mota, thank you so much for your time today.
Thanks, Alicia.
As we saw in yesterday's GDP data, household spending has seen a massive rebound since the depths of the retail downturn this time a year ago. April retail sales have continued the trend, rising 1.1% from March to be 25% higher than when lockdowns were in full swing. Food, household goods and clothing rose. Department stores went backwards, and our COVID love affair with cafes and takeaway food continued. New South Wales and the ACT led the way in consumer spending, while Western Australia was the only state to go backwards. And the share market hit a new high, helped by the slew of positive economic news, as well as soaring commodity prices. The top 200 stocks closed at a record, and both indices added more than 0.5% for the day. And the Australian dollar is a little lower against the greenback. Fiona Clark from Merrick's Capital joined me from lockdown in Melbourne after the market closed. Fiona Clark, a fresh record on the market today. Do you think it's got much further to run?
Yes, it's a good day to be talking about markets when we're hitting another record high. Listen, an old boss used to say to me that stock markets are like good parties, that they're great until they're not, and you don't want to be there once everybody's left. And then again, you don't want to leave before the fun ends. So I think that's pretty much the same here for the stock market. I think in terms of the supporting fundamentals, we've got some really good things to support valuations and earnings, including good growth, economic data that we've seen. But we're also seeing some things start to top out a little bit, commodity prices, etc. And of course, stock markets lead the economic fundamentals. So I would be cautious. I'm optimistic, but certainly there are reasons to be cautious about how much further this strength can continue.
Well, you mentioned commodity prices, and mining and energy stocks have been providing quite a bit of support lately because of rising commodity prices.
Yeah, so the energy sector was the best performing sector today, up 3.3%, and it comes after yet another increase in the oil price overnight. So oil's being supported by a number of factors, including slow pace of uranium talks between the US and Iran, nuclear talks, I should say. But the other key factor is that OPEC and its trading allies announced that they were going to go ahead with cuts to or bringing production back online. Normally, you would think that production coming back online would be negative for markets, but in fact they're doing that because they see the prospects for demand growth to be so strong that they can increase production.
And when it comes to individual stocks, there are quite a few hitting records as well, CBA in particular.
Yeah, so CBA is a record high, over $101, I think 21 today, and a couple of others that pose some interesting themes. So in the takeaway space, we've got Domino's and Collins Foods hitting all-time highs. Renovation-wise, we've got Wesfarmers and Reece also making an all-time high, and ARB Corp. So those stocks are all doing well based on those themes that we've seen in a COVID environment.
But Wesfarmers came out today and said it doesn't think it can back up its COVID sales from the last period.
Yes, in fact, the Wesfarmers investor update today was broadly in line from a thematic basis with what we saw in the retail sales data, which is that because we're actually rolling off that very poor performance from last year, that the monthly numbers are quite volatile, and for some of its stores and sectors that we will see some negative growth. In particular, it referred to the catch business, which has seen growth in the last quarter actually negative, partly as a result of us sort of moving more to an in-store experience rather than an online experience. The Wesfarmers share price did close down 2.1%, a little bit of disappointment, but one of the good things that came out of that update was that the cost involved in converting those Target stores to Kmart stores has been downgraded to 60 to 70 million for this financial year, down from the original estimate of 90 to 110. So some bright spots to look for in that announcement.
One particular bright spot on the market today was the buy now, pay later stock Sezzle. Its shares sizzled today.
You stole my line. Yes, a sizzling performance from Sezzle. A good result there and a big announcement. So Sezzle has announced a 3-year deal with Target in the US for its buy now, pay later arrangement to be available in store and online.
Fiona Clark, as always, thanks for keeping us updated.
Pleasure.
And that's all from The Business. For more on those stories, you can go to our website and click on the business page, and you can catch up with the program at any time on iView. I'm Alicia Barry. Thanks for your company. Good night.